Hello and welcome to our webinar. On this webinar, we're going to be talking about non-performing notes and why now is a great time to consider an investment in non-performing notes. A little bit about myself and our company. My name is Beth Hale and I've been investing in real estate for over a decade. This includes buy and holds, wholesaling, and property management both locally and in the southeastern United States. I founded Denver-based United Capital, and we are fortunate enough to be staffed by a team of experts with over 72 years combined experience in the mortgage note industry. My partner, Skip Shanker, has more than 20 years experience in the mortgage note industry and is an expert in financing distressed properties using the underutilized FHA 203K government renovation loan program. He's also the founder of ReadyForRemodel.com, and Skip pioneered an online marketplace where people can buy fixer homes with fixer loans. So tonight we're going to be talking a little bit about the state of the real estate industry and the investment industry. This article came out in the New York Times earlier this year, May 6th, and it says, with relatively little fanfare, the stock market has become expensive again. A Nobel laureate in economics says stocks have been more expensive only 3 times in the last century: the 1920s, the late 1990s, and in the prelude to the 2007 financial crisis. Well, what could possibly go wrong, right? This slide shows housing inventory in millions, and I'm sure it's no surprise to you that our housing inventory peaked across the country in August of 2008, about the peak of the recession. But I think what's interesting about this slide is the difference between the third bar and the fourth bar. That's a drop of over 500,000, and that represents the 5-month period between August 2012 and January 2013. Housing prices are up across the country. In the year ending July 2014, home prices rose 7.4%. What about the impact of hedge funds on inventory? So where's all this housing inventory going? These are just 6 of the largest hedge funds, and you can see from this slide that they bought over 75,000 single-family homes in 2013 in America. And they raised another $8 billion to continue doing so. Hedge funds are also making a move into tax liens. In 2008, it was estimated that hedge funds controlled about 5% of the tax lien market. Today, they control 40% of the tax lien market, or more. Real estate investors are paying more. According to the National Association of Realtors, in 2012, short sales sold at an average 13% discount to the value of the home. Foreclosures sold at an average 21% discount. In 2013, those numbers got shaved even further. Short sale investors only got a 12% discount, and foreclosure investors got an average 16% discount. What about non-performing notes? Now this slide shows what a bank might have looked like just before the real estate crash, with the big building being the lending department and the small building on the right being the loss mitigation department. Compared with today, well, they just switched places. Now that's just a little bit of mortgage humor, but it's not awfully far from the truth. Mortgage delinquency is still a problem in our country. In fact, it's at an all-time high, which might sound a little strange. I mean, aren't things supposed to be getting better? Well, the industry defines 6% delinquency, and that's homeowners who are 90 days or more behind on their mortgage, as an indicator of a stable market. In other words, even a stable market has a 6% delinquency rate. In August of 2013, that delinquency rate hit 10.63%. And in April of 2014, the delinquency rate hit 11.89%. And the FHA by itself is over 25% delinquent. And they announce they'll be getting out of the foreclosure business and will sell non-performing loans instead. In June of 2014, the FHA sold 25,000 non-performing loans. Now, what about the non-performing note inventory? It's estimated that there's less than 400,000 REOs across the country. And an REO is a bank foreclosed property. That's what properties become after they've become foreclosed on by the bank. They become REO properties. It's estimated there's 9.5 million delinquent mortgages. This graph shows that since 2008, non-performing loans have drastically outnumbered REOs and short sales, and they still do. So let's talk a little bit about the opportunity. Now, do you remember this slide that said that in 2013, short sales sold at an average 12% discount and foreclosures sold at an average 16% discount? We'll use those numbers because they're the most recent. Non-performing notes sell anywhere from a 35 to a 65% discount. Okay, so let's take an average investment property that's worth $200,000. Now, according to the last slide, the short sale investor gets an average 12% discount on the price of the asset. So that means he's going to pay $176,000, leaving him a margin of $24,000 to go toward all of his other costs and hopefully turn a profit on. The foreclosure investor gets an average 16% discount on the price of the asset, so that means he's paying $168,000, leaving him a $32,000 margin. The non-performing note investor will get anywhere from a 35 to 65% discount, so let's just shoot right in the middle and say he pays $115,000 for the note which is backed by the house, leaving him an $85,000 margin. Let's talk a little bit about our strategy after we acquire these notes. We can either modify the loan, which is where the borrower wants to stay in the house, and since we purchased the note at a discount, we can offer him a modification on his loan. So the borrower will pay a lump sum, get a lower monthly payment, get to stay in the house, and we will get a reperforming note, which we can either sell to another investor or keep for the monthly cash flow. Everybody wins. If the borrower doesn't want to stay in the house or can't afford to stay in the house and wants to avoid a foreclosure on his record, we can do a deed in lieu. If the borrower can't be contacted or won't sign a deed in lieu, we get a foreclosure. Either way, we end up with the deed to the house. So let's look at a loan modification case study. This is an actual note that was for sale in summer of 2014. The property that secured the note was in Homestead, Florida. It was a 3-bedroom, 1-bath house with an estimated as-is value of $84,000 and an estimated after-repair value of $92,000. The amount still owed on the note was $148,000. The P&I payment, although it was delinquent, was $1,024. The asking price on this note was $43,000. So, these are the borrower's current terms. The unpaid balance of $148,000, an interest rate of 7.39%, amortized over 30 years, gave him a P&I payment of $1,024. What if we gave him new terms with a down payment of $8,000 and financing of $88,000 at an interest rate of 8.5%, amortized over 20 years with a new P&I payment of $764. So that borrower's payment went from $1,024 down to $764. That's a pretty good deal for the borrower. Now, let's say we collected those $764 monthly payments for a year and collected $9,168. Then let's say that we took the remaining 228 payments, sold them to an investor for $60,000, giving that investor a yield of 14.25%. What would our return be? Well, we paid $43,000 for the note. Expenses for the modification would be about $2,000. This one did have back taxes of around $81.63 for a total cost of $53,163. We received an $8,000 down payment from the borrower. We received the 12 monthly payments of $9,168. We sold the remaining 228 payments for $60,000. So our total received was $77,168 for a profit of $24,005 and a cash-on-cash return of 45% in a little over a year. Not bad. Let's do a deed in lieu case study. Now again, this was an actual note backed by a property in Oklahoma City, Oklahoma. The estimated value as is was $36,000. The estimated after repair value was $44,000. This property was occupied. They still owed $28,363 on the note. Their P&I payment was $226, and the average rent was in the area was $680. This note had an asking price of $14,181. Now this one isn't really a good candidate for a modification because their P&I payment is only $226 as it is. So we can't really improve on that, and they're not paying that. They defaulted on that. So this one isn't a good candidate to be modified. So instead we'll do a deed in lieu of foreclosure, which once again is where the borrower agrees to deed over the property in lieu of foreclosure. We sell the property to a rehabber or end buyer, or keep the property for the rental income. So what's our return if we were to sell this property as is? Well, we paid $14,181 for the note. Our expenses were around $2,000. Taxes on this one was $1,381 for a total of $17,562. We're going to sell it for $36,000, less selling costs of around 10% or $3,600. So we'd get a total of $32,400 for the house for a profit of $14,838 and a cash-on-cash return of 84%. Again, not bad. What about if we kept that property as a rental? Our expenses are going to stay the same. The monthly rent in that area was $680. Less expenses of around $200 for things like taxes and insurance and property management. That leaves us a net income of $480 a month for a cash-on-cash return of 32%. Let's talk about a foreclosure case study. And again, this was an actual property and an actual note. My colleague purchased this note. It was backed by property in Newport News, Virginia. The estimated as-is value of the property was $55,000. This one did need a rehab. Its estimated after repair value was $86,000. It was a 3-bedroom, 2-bath, and the market rent in the area was $860. The asking price on this note was $13,000. Now, he didn't want to modify the loan, and he didn't want to do a deed in lieu, so he chose to do a foreclosure. And again, that's where you foreclose on the property and obtain the deed, sell the property to a rehabber or end buyer, or keep the property for rental income. So, if we were to rent out that property after the rehab, what would our return be? Our expenses were the note cost $13,000. Expenses for a foreclosure are a little higher, so we figured a very conservative $8,000. Rehab costs of about $20,000 for a total cost of $41,000. Monthly rent in the neighborhood is $860 for this type of home. Figuring monthly expenses of $250, that leaves us $610 a month net income for a cash-on-cash return of 18%. What's our return if we were to sell the property after rehab? Once again, our expenses stay the same. Our sales price is $86,000, less selling costs of about 10% for a total of $77,400. Profit of $36,400, a cash-on-cash return of 89%. Now I just want to say a couple of words about purchasing non-performing notes through an IRA or other retirement vehicle. Self-directed IRAs or any of the other self-directed retirement vehicles, such as self-directed 401ks or the 529 college account, can be excellent sources of funding to buy these non-performing notes with. And the Roth versions of these self-directed retirement vehicles can grow your wealth tax-free. Now, you've seen some of the returns that are possible with non-performing notes. This can be a great way to build wealth inside your IRA. If you have any questions about this, if you want help setting up a self-directed IRA, or if you have any questions about today's presentation in general, please don't hesitate to contact us. That's what we're here for. We work with investors, helping them grow their wealth inside and outside of their IRAs through investing in these non-performing notes. And we'll show you how to contact us in the next slide. Now, obviously, before you buy a non-performing note in your IRA, or even outside of your IRA, you need to do some homework, like what's the condition of the house? What about back taxes? What about second mortgages and other liens? Well, my team and I started putting together a list of due diligence items, and we've come up with 25 items so far. So if you will email us at the address that's going to appear on the bottom of this slide and put free report in the subject line, we'll be happy to email you a free report about due diligence necessary before you purchase a non-performing note. So once again, if you send an email to Beth at unitedcapital-llc.com with free report in the subject line, we'll be happy to send you our free report entitled Due Diligence Items to Consider When Purchasing a Non-Performing Note. Now, for those of you fix and flippers out there, and for those of us buying non-performing notes, wouldn't it be great if we could get the after repair value of the house minus the cost of repairs without going through the headache of the rehabbing? Well, my partner Skip Shanker and Ready for Remodel has come up with a very interesting program, and here's how it works. Skip's company takes pictures of the inside and the outside of the house and then mocks up a possible remodel scenario. So instead of looking at a before and after photo here, you're actually looking at what is photos on the left and what could be photos on the right. Then, using local contractors and realtors, repair cost estimates are generated. In this case, they did 3 different scenarios, and you can see them there in the gold, the silver, and the platinum, or the silver, the gold, and the platinum. And you can see that they've figured in the cost of the construction loan on the right under that FHAMI line. So for the silver package, it's going to cost $114.41. The gold package is going to cost $118.29, and the platinum package is going to cost $122.18. And really, that's not too bad when you consider they're getting to rehab the property for just an extra $150 a month. Now, Skip would be on this webinar, but he's actually in Washington, D.C. meeting with our new HUD secretary, and I don't mean to name drop, but that's really what he's doing. So in conclusion, why consider non-performing notes? There's a bunch of good reasons. They have a higher yield potential and lower risk than traditional investments. They provide the security of being backed by real estate. There's a multitude of exit strategies to provide both capital growth and income. And reperforming notes provide passive income without tenants and toilets. So we thank you very much for listening to our webinar. Please don't hesitate to contact us with questions. Again, there's the email address down below. And thank you again for being with us tonight.